Welcome. Let's discuss about the future of the car business. As the adoption of EV becomes closer, it is no secret that legacy automakers like GM and Ford are having difficulties. You may have seen headlines stating that the CEO of Ford is shocked by the rate at which EV adoption is happening and that Tesla has crashed. However, in a surprising turn of events, renowned money manager Cathie Wood, who has historically been loyal to Tesla, recently changed her position on legacy automaker GM. Following Wood's shift in position toward GM and DM's recent difficulties, Cathie Wood's ARK Investment Management recently made an investment in GM. We'll be discussing why Wood's prediction is so important, what it means for the larger auto industry, and how Tesla's recent price action will affect industry perceptions for years to come. The success or failure of Wood's new perspective on GM cuts fit into the image, but before we continue, hit the like and subscribe buttons. Don't forget to turn on the notification bell. 2, Wood estimates that Tesla's stock might rise to an incredible $3,000 by 2025. This prediction is not only amazing, but it also shows the difficulties that established automakers like GM and Ford may encounter in the years to come as they attempt to compete with the more innovative and younger businesses. This Exim's forecast stands in sharp contrast to other analysts' more optimistic assessments. Such Morningstar's in a recent interview with Sandy Monroe, David Whitney, who believes that GM stock has a fair value of $68. Jim Farley, the CEO of Ford, acknowledged that the business has lagged behind in terms of EVs. In order to navigate the current market trends in China, where digital EVs products are gaining more popularity, with China being the largest market in the world and exporting to countries like the Netherlands and Norway, Farley said he wanted to address Henry Ford's achievement and how Ford won the world by creating an affordable car for everyone, according to Farley. It's critical to understand that success will depend on providing goods at a range of price point, rather than just luxury goods from the 1970s. Ford, on the other hand, believed that it could compete in the sedan and hatchback market, but for its business in Europe, it struggled and discovered that its strength lies in the pickup truck industry with Maverick. Farley said he observed GM's market share drastically decline from 60, nearly nothing, while Toyota previously had no market share, soared to the top due to producing the cars that people wanted. Farley believes that considering the entire market, not just the limited portion of it, is the winning strategy. Ford should be proud of their 95 electric Advance, according to Farley, even though Cathie might not think so. In a surprising turn of events, ARK Invest Management has acquired over 150 shares of General Motors GM for its autonomous technology and robotics fund. Ford is currently in second place, just behind Tesla, with 6.2% of the EV market share. ARK Q Wood had previously criticized traditional automakers for not being able to keep up with innovation. So this purchase marks a significant change in her viewpoint. Wood's team met with General Motors CEO Mary Barra to discuss the company's plans for electric vehicles during an interview with Yahoo Finance. The decision to invest in GM is significant because it shows that even a well-known stock picker, known for our bets on high growth technology companies, is recognizing the potential of legacy automakers in the rapidly evolving auto industry. It also shows that GM's efforts in electric vehicles and autonomous technology are being noticed and could potentially pay off in the future. Wood revealed that ARK was considering investing in GM and was keeping in mind about it. Wood's investment in GM is encouraging, not only for the business, but also for the auto industry as a whole. It shows that established automakers can change with the times and still be competitive, particularly in markets for autonomous technologies and electric vehicles. It also emphasizes the possibility of cooperation between more recent innovative businesses like Tesla and legacy automakers. As the auto industry continues to change, investors will need to keep an open mind and take a variety of factors into consideration when making investment decisions, according to Cathie Wood. The move by ARK Investment Management also serves as a reminder that investing in the stock market is not just about picking winners, but also about being open to new opportunities and changing perspectives. Recent price reductions from Tesla present a challenge for other automakers hoping to stay competitive rather than a danger to the brand. Wood thinks that Tesla's cost leadership and battery technology are to blame for these price reductions, and that other manufacturers must adopt this technology to stay profitable and competitive. The company will continue to gain market share and expand its reach, in addition to the advantages of spreading fixed costs and negotiating better deals with suppliers. These price cuts are not a sign of weakness for Tesla. Rather, they are a strategic move that will likely strengthen its position in the market as other automakers struggle to keep up with its pricing. Because of economies of scale, Tesla can gain a competitive edge in the market as it produces more electric vehicles and can use price to draw in more customers and increase its market share. This can result in higher sales volume, which will enable Tesla to further expand its economies of scale and solidify its place in the market. Additionally, when Tesla's manufacturing volume rises, it will be able to invest more into upgrade its goods and create new tactics, which will strengthen its competitiveness. Advantage makes it harder for rival automakers to overtake Cathie Wood's outlook. Some Wall Street experts, however, have a different perspective on Tesla's recent price cuts. They worry that these reductions could harm the company's profit margins and eventually damage the company's brand value. Certain observers contend that Tesla's brand is founded on the idea of exclusivity and elegance, which might be undermined by more affordable models. However, proponents of Tesla contend that the company's cost leadership, battery technology, and economies of scale will allow it to maintain its margins while lowering prices. They also believe that lower prices will allow the company to expand its market share and continue to innovate in the EV space. Yes, it's true that legacy automakers have been slow to adopt new technologies, particularly electric vehicles, which is one reason Cathie believes they're in trouble. Some critics also point out that Tesla's ability to continue lowering prices could be restricted by rising costs in the supply chain or battery production. Tesla has been a leader in this area, investing heavily in EV technology and developing high-quality, affordable electric cars that have gained popularity among consumers. In contrast, many legacy automakers have been hesitant to invest in EVs and have continued to focus on gas-powered cars, which has put them at a disadvantage in the rapidly evolving automotive industry. One reason for this slow adoption of new technologies is the complex and capital-intensive nature of the automotive industry. Legacy automakers have long-standing relationships with suppliers and dealerships, and changing their business model to incorporate new technologies can be difficult and expensive. Additionally, they may be reluctant to invest in EVs due to concerns about the high cost of battery technology and the lack of charging infrastructure. However, as consumer demand for EVs continues to grow, legacy automakers are starting to invest more heavily in the EV technology. Many have announced plans to launch new electric models and to phase out gas-powered cars over the coming years. While they may still have some catching up to do in terms of innovation legacy, automakers are beginning to recognize the importance of embracing new technologies to stay competitive in the marketplace. This is yet another key factor that Wood believes is contributing to the challenges faced by legacy automaker. New entrants into the market like Lucid Motors and Tesla Rivian are concentrating on creating electric cars and have drawn substantial funding. These businesses are upending the established auto industry and forcing legacy automakers to change with the times while competing with the newcomers. Regulating issues also confront legacy automakers. Governments everywhere are enforcing more stringent pollution laws, which will make it more challenging for automakers to keep producing gas-powered vehicles concurrently. More TV investment is being pushed for by regulators, which will increase pressure. That's all for this video. If you enjoyed it, hit the like and subscribe buttons. We'll see you in the next video. See music. Legacy automakers that have been slow to adapt to stay competitive in this changing landscape will need to invest heavily in new technologies and adapt their business models to meet the demands of consumers and regulators. Yes, this may require significant changes to the supply chain, manufacturing processes, and marketing strategies, but it is essential if they want to remain relevant in the automotive industry. With gratitude